Hello, everyone. Today we are joined by Stephen Hamilton. I'm sure that everyone listening knows who Stephen is because both when I was in New Zealand, he was very well known. He's very well known in Australia. Stephen's an assistant professor of economics at George Washington University and also a visiting fellow at TTPI, the Tax Transfer Policy Institute. And he's a regular commentator at AFR and across the news in Australia on a whole range of issues. Lachlan, Stephen, and I were chatting, and we noted that Stephen knows a lot about tax. That's his speciality, his area, and yet no one seems to actually ask him about that. Instead, asking about monetary policy, JobKeeper, state capacity, defense spending.
Yeah.
So thought we'd have a yarn. How's it going, Stephen?
G'day, mate. Great to be here.
So we're chatting just before the budget, but quite keen for this to be a much more long-term sort of view about what tax reform in Australia should look like. I'd just really like your perspective on how you see the Australian tax system now and how urgent you think a reform agenda is.
Yeah, so it's an interesting question. I mean, obviously, we want tax reform. We would like our tax system to be better. That's like, like who wants the tax system to be worse, right? So the question is, I guess, what kind of, like, the first question I would ask is what kind of reforms are feasible? And I'll be honest. I mean, right now, I think the worst possible thing for Australia would be tax reform. Like if this morning Jim Chalmers woke up and said, "I want to do tax reform," I would go, "Hold on, hold on, pal. Let's back it up, back it up, back it up. Maybe we could do that in 2 or 3 years." But I really don't think we are ready to meaningfully embark on a reform process. And so my view would be, I don't think we need tax reform today, but I think we should be instead focused on getting the ball rolling so that in 2 or 3 years, ahead of, say, the next election, maybe whichever government is in place, whether it's Labor or the coalition, they're in a position to take something to the next election that is actually credible, high quality, important, a high priority. But I think we're a ways from that. And I will add to that I think, the things that I think the government would do right away, I think would be almost certainly bad. And I look at Labor's policies from 2019 in particular, and I think that was not the kind of like these are reforms, and maybe people who aren't super informed might look at that stuff and go, "That's what we need. We need Labor to do that again." But I look at that stuff and I think it was mostly bad. And so if they're going to pull some of that off the shelf, I'm like, no, I'd rather no reform, thanks.
I see. So no, that makes a lot of sense. So thinking about my conversations with tax people in New Zealand and Australia, something that both countries were very proud of was the broad-based low rate type systems and sort of equal treatment of income. And when you're talking about Labor's reforms, there was discussion about, negative gearing and not allowing admissible expenses and the such. I'm guessing you're coming
Which I think I've read that you have a correct view on this.
Yeah,
if I remember correctly.
I'm glad to hear.
You have the correct view. But there it is a good example of what's wrong with the reform discussion, right? Where if I took a poll, I think I'm sure maybe Peter Martin has done this. If I took a poll of even Australian economists and we asked them, is negative gearing good or bad? I think a significant portion would say it's bad. And to a tax economist, that's completely insane. I mean, that's like, I do not know a single, top tax professor in the world. I do not know a single one who would say negative gearing is bad. They would say that doesn't even make sense as a statement, right? And so the fact that, that is so widespread as otherwise seemingly sensible individuals who say, oh, that's what we need, I think that's a great sign. Labor, committed in 2019 to roll it back. And I think that was crazy. And I think that's what would be one of the top things to be done if they were to embark on it now,
Yeah. And I think your point's really really useful as well. Back in New Zealand, I had this chief economist, Matt Benj, and he was, formerly in Australia at ANU as well. And his view was that Australia embarked on broad-based low-rate tax reform through the 80s, and then there was a process of turning around and saying, "Oh, how can we solve a singular problem by poking holes in this?" And
Yes.
Australia, in terms of how much it subsidizes superannuation as well, is often a warning case in New Zealand that this is how you destroy your comprehensive income tax system. Do you feel like that's a fair description of where Australia went through that 30-year period?
No, I think that's exactly right. I mean, and we can we can have a debate about some of that 80s stuff. I think a lot of people have misgivings about FBT, for example.
Mm,
And I think we can all agree that the FBT system is not perfect. On the other hand, the concept of taxing fringe benefits is very sound. Like it's a
yeah.
perfectly sound thing to do, right? So it's not crazy in concept. Maybe the implementation is not perfect. I think franking credits are another good example of from
Mm,
something that came from the 80s. That when I talk to my friend who's a professor at Columbia, Wojciech Kopchik, and I tell him Australia has a comprehensive pass-through corporate tax system. He's like, "What?" And he would kill for a full pass-through system in the
yeah.
US, for example, right? So, is the franking credit system perfect? No, actually, I might, if we were thinking about redesigning our corporate tax system, I might actually get rid of it. But like the point is, I think most of the 80s reforms had a sound basis. I think the
Mm,
people working in Treasury who were driving this stuff, the government itself, I think everyone kind of had a good understanding of what the right answers were, right? And I think there was almost a consensus, right? Now, some of that comes from like Asprey, right, which was like late 70s.
mm,
But I think we tilled the soil. I think there was a consensus among experts. There was a government willing to drive the tax system in the right direction. And so you put all of that together, and I think we got reforms that made the tax system better. And I think the GST and the other 2001 reforms were much like that, right? Same
mm.
thing. I think everyone kind of understood these are the basic this is the basic thing we need. Is it perfect? No, but like I think everyone was pushing in the right direction on that one, and that's the thing that I don't see right now. I don't see a clear kind of coherent kind of push in a certain direction.
Mm.
And that's, I think, people like us, people who aren't in treasury, who aren't in government, I think have a big role to play in trying to marshal kind of that thinking and that advocacy and the explaining to the public and the explaining to the experts, frankly, so that we all get on the same page about where we need to go. So I think that this is a kind of a meta conversation, right, about like
Mm.
the nature of reform rather than the nitty gritty of the tax system. But I actually think it's like square one. I think we've got to get on the same page, work at informing people. This is why I write in the Fin about tax all the time, right? I'm trying to like send a signal to people who are reading, what is good and what is bad tax policy, so that we can finally pull together some kind of agenda. And that's got to be the beginning of it, I think. So I don't know if you want to talk about specifics. I mean, I think it's funny because New Zealand, I think of the New Zealand in many ways as being a kind of I mean, I don't know what you'll think about this, but so many people would suggest it's kind of ideal in many policy dimensions, almost like an outlier in this. So how did they get away with it in New Zealand? I mean, you're one of the first, if not one of the first, to have inflation targeting. I think,
Yeah.
independent central banking and inflation targeting. You have this GST, which is the envy of the world in its purity. you know, I don't know much about the New Zealand system, but my sense is if I was to compare Australia's system with New Zealand, there's many areas where I think the Australian system falls down and we could move in the New Zealand direction. I don't know if you think that's right.
Yeah, yeah. I mean, I would broadly agree with that. The one issue that comes up is New Zealand does not have a capital gains tax. Essentially, when the
Oh,
reforms were made, the idea was it should be comprehensive income, and so capital gains at full rates. And then 1989, getting close to an election, trying to work out how the final stages of tax reform should look. The finance minister at the time, Roger Douglas, just completely changed his mind, and it's sort of a mystery why. He's a very principled guy. Some people find him over ideological or that he misses certain social policy aspects of things, but he had a very clear vision for tax
yep.
reform and then gave away the capital gains tax. So you do have assets that are captured, foreign shares, uh, like short turnover housing. If you hold the house for less than 10 years, you're taxed capital gains at full rates. But a lot of things are excluded, and it leads
But
to a
not their
whole.
family home.
Uh, I'm trying to remember. I'm trying to
Because
remember.
Australia's primary residences are exempt from CGT.
Yeah, yeah. I think the family home might have an. They're called the I've forgotten the name of the rules, but there's these certain rules about length of time, and they were relatively recent, say a decade ago. That if you held a
Mm.
house for less than 2 years, you were seen as an investor, and it would be taxed as income
Oh,
rather
I
than
see.
treated as
I
a
see.
tax-free
Sure.
capital
Yeah.
gain.
Yeah. And
Um,
that's many countries have like less than 12 months, even on stocks.
yeah, yeah, yeah.
Stocks held for less than 12 months taxed as ordinary income. So I mean, I think so. If you bought stock and held it for longer than that, it would not attract any capital gains.
Oh, if you bought domestic stock and flipped it immediately, it wouldn't hold as capital gains. If it was in a sort of closely held company, or you
Yeah.
you were a related person, well, then it would probably be treated as income instead under different
Yes.
types of avoidance rules. But
Yes.
the New Zealand system, that's one thing that there has been public push for a capital gains tax. The tax authority has repeatedly asked for it. Um, and it just hasn't gone through. The multiple tax reviews recommending it.
Yeah.
Um, but that's the one glaring gap. But when it comes to the
Oh, interesting.
GST and there's also no deductions for labor income, so you can't deduct work-related expenses, which
I
creates
see.
tension as well. But
Yeah.
that was seen as an anti-avoidance type rule.
Yeah. And I think that's a hard one. I mean, when I was at Blueprint, I worked up a kind of proposal for a standard deduction, which,
Mm.
we kind of laid out the economics of this there. But I really love that document. Actually, it's one of the things I produced in my career that I'm most proud of. Like
Mm.
it has a sort of beautiful synthesis between serious economics and kind of policy application. But there's a for genuine work expenses, it's perfectly legitimate to offer deductions. You should be taxing net income, right? So
Yeah, yeah.
there's nothing weird. That's more, you'll get a more efficient tax system if you do that. But there's two problems. One is there's a huge compliance and administration burden, and two, there's as you said, a big avoidance opportunity because it's very difficult to determine what is and is not legitimate. And if it's just consumption, it should definitely not be deductible,
Yeah,
right? So
yeah.
so you end up in a world where you're in the second best, right? And so having a standard deduction where you effectively outlaw most of that stuff, and you pay it off with a tax cut, which is effectively what a standard deduction does, and then it leaves the really tail end of people who are doing a lot of deducting that maybe you want to allow them to, and you're in a second best world, but you end up with pretty big welfare gains, is what we kind of estimated, because there's this wonderful paper. I don't know if you know the paper, but it's by Yusuf Benzati at UC Santa Barbara, and he basically looks at the U.S. standard deduction. I think it was his job market paper. He looks at the U.S. standard deduction. So in the U.S. we have a standard deduction, right? You can anything below this, you don't bother, um, you know, um, putting all your individual items down. We call it itemizing. And if you
Mm.
have deductions above the threshold, would you bother itemizing? He looks at bunching around the standard deduction threshold. So if you look at where the standard deduction begins, you see this big spike in deductions, and then it kind of falls, right? So by looking at how many people are bunching at that standard deduction minimum, you can, or I should say standard deduction maximum, like the floor, you can basically infer people's willingness to avoid, going through all the hassle of itemizing. And it's pretty significant. It's in the several hundreds of dollars per year per person in terms of people's willingness to avoid itemizing. So they're basically giving up, legitimate deductions that they could claim, just to go with the standard deduction. And so that gives you a kind of, I don't know how wonky you want to be. I guess we're there now, but it gives you a kind of reveal preference measure of people's willingness to avoid having to itemize, and that could tell you, okay, how much would they prefer a system where they lose these deductions, but they have a standard deduction, and you end up with like compliance cost savings in the many billions of dollars. Like, it's not trivial, right? So, no, in Australia, that's a huge problem. If you talk to, I talked to Chris Jordan, the ATO commissioner, and he just is very insistent on these work-related expenses as being a massive source of kind of tax avoidance. And I think this would basically wipe it away. And the other advantage to moving to a standard deduction, which I would like to see in Australia, is that you could allow them a massive simplification of the tax filing process. You could move to a world where you just don't file a tax return. It's just kind of, you could have very precise. We kind of over withhold people because we want people to have extra money there. We could have much more precise withholding. We could get rid of that whole process, and you could save, a lot of compliance costs on the ATO side, and administrative costs on the ATO side, and a lot of compliance costs on the consumer side. So I think we estimated a standard deduction in Australia was like cost about $5 billion a year or something. But it's a pretty big tax cut for people who aren't claiming a lot of deductions. So, that's an easy, like, if the government did say to me, like, right now, what should we take to the election? Like, that's something they could just roll out. And it would cost a bit of money, but you'd actually get a kind of efficiency benefit from it. I don't know if you want to talk about so I wonder, like, we're going to talk about different categories of taxes, obviously, like, and we might, get there as we discuss. But I wonder if it's worth talking about some principles. The kinds of things that we sort of say, what is a good tax system? Like, how does Australia need a tax reform? Well, it kind of depends what you mean. Like, what does a good tax system look like, and how far are we away from it, right?
I think that's important. So a lot of the audience here, the like very small number of people that will tend to be public servants from both sides of the Tasman. Because a lot of people that reach out to me about the things on the podcast are different public servants. And so knowing frameworks and principles, that's where all the money is.
Yeah. So I mean, I'm going to write in the Fin on this in a few weeks, because I want to write about tax reform before the election. But and I've been thinking a little bit. I mean, everyone always says, efficiency, equity, simplicity. That's what everyone says, right? That's efficiency, equity, simplicity. That's what everyone says. I think that's what the Henry Review said when they did that back in 2010. I don't like it because I don't like simplicity as being a separate thing. I don't understand simplicity as being different to either of those things. Simplicity is good because it's more efficient, or it's more equitable. It's not another thing. It's just one of the other things. Simplicity is bad to the extent that it generates horizontal inequities. Simplicity is bad in the sense that, you lose efficiencies, or simplicity is good in that you gain efficiencies. So, I always think it's equity efficiency. And there's this great book by Arthur Oken, Equality and Efficiency, The Big Trade-Off. I've got a copy of it in my office, and I always try and get my students to read it. But that sort of frames as those two, objectives, which I think frequently are in tension.
It is a great book.
So that's a sort of that's a fairly reductive. I think most people listening probably understand that. I think what's more useful is a little bit more drill into kind of specific, maybe slightly counterintuitive ideas. And I'll give you one, and maybe that can kick off, what we talk about. But, and I'd be interested to know, especially where you used to work, whether you feel the same way. There's a huge problem in tax policy. And let's put it this way, the Treasury, and this is wonderful because it's alliteration with TR. So the Treasury is worried about the treasure when they should be worried about the triangles. So there's a nice, there's a nice kind of like encapsulation of something that I think is a big problem in the way we talk about tax policy and think about tax policy. And I think a big impediment to good reform. Treasury, especially in Australia, and I don't know if you agree in New Zealand, but there is a real accounting mindset where they are, and they are just they are obsessed with losing revenue, and they want to hold on to the revenue at all costs, and they're unwilling to, do a reform that costs money on net. Like you could do a tax reform and it costs 5 billion or 10 billion or 20 billion a year. And that's really like, oh, we can't do that. We can't give up the revenue. And completely ignoring like the advantages of that, right? Which are the, potentially massive efficiency gains that could, in the long run, more than pay for the reform, right? And I think it holds us back. And the most prominent example of this, and by triangles, I mean the Harburger triangle, right? The deadweight loss triangle that anyone who's done economics knows. I think that the best example of this in the Australian context is the corporate income tax, which in Australia is incredibly high, 30%. Which today is like one of the highest rates in the world. And it doesn't apply to domestic investors, but it does apply to foreign investors, who are the ones with the greatest elasticities, right? The ones most likely to flee in response to the high rate. And Treasury's view is that they will not cut the corporate tax rate because they'll lose too much revenue if they do that, and they're basically worried about collecting less tax revenue from mining companies. And so I wonder, do you agree that that's a problem? Is it a problem in New Zealand? And is this something that, like, is there a way to get them to kind of change their thinking?
No, I think that's a good point. And I think in New Zealand, the advantage that they have had for these things is having sort of a lot of the responsibility for tax policy shared between the Treasury and the tax authority. So you'd have direct policy and economics teams within the tax department who were then, very focused on behavioral changes and trying to think about deadweight loss rather than just, are we getting the most revenue possible? And there was a definite difference in culture between how you would treat a tax expenditure versus the tax system. So tax expenditure were things that the Inland Revenue Department would protect against and would be trying to avoid changing, while the actual tax system, it was about efficiency and some forms of equality, and thinking about horizontal equity was a huge part of how New Zealand thought about tax, and it was like a driving part of how you would ever look at things. Are we treating similar looking actions and similar amounts of income in the same way? And if we're not, we're willing to spend money on this.
Yes.
And so taking the example you had with same sort of corporate tax system, same high corporate tax rate, same pressure for that to be lower to increase investment, and the same view that if you have an imputation system like we do and foreign investors can't receive that, it's just going to increase the required rate of return for a foreign investor to invest because they could invest anywhere in the world. So that all gets passed on domestically. So that's all sort of spelled out. And the Inland Revenue Department actually put out documents talking about those trade-offs and talking about the revenue it would cost and the fact it would increase capital depth. New Zealand has a big capital depth issue, unlike Australia. Yes. But the big thing was, it was always this view that there are location-specific rents. So if people were investing in New Zealand and they were earning a rent by doing so because of something about the land, the corporate tax is allowing us to tax that and get that revenue from overseas. And it was, can we measure the trade-off between the two? And the thing that they struggle with in New Zealand is the teams are so small, they can't do the work. But for providing that framework, I think the framework discussions were pretty strong.
And a related point is the lack of what we in the US would call like dynamic scoring, which is a description of the way the CBO does its costings of government policies, right? And it's whether you account for the kind of economic, you know, what do you call it? Second round effects, or there's all sorts of different names for this. But my sense, I mean, I recall this from when Malcolm Turnbull was the Prime Minister in Australia. There was a discussion of perhaps raising the GST and lowering income taxes, and sort of just doing a tax mix switch from consumption, income to consumption, and the point was that revenue neutral policy would generate very little benefit. And it's like, well, yes, but maybe you're not accounting for the kind of long run economic benefits of greater saving rates, maybe you're not accounting for the economic benefits of higher levels of compliance, right? Which we would get much more compliance with the VAT, the GST than the income tax, for example. So, there is a lack of sort of that sort of obsession with those economic, the triangles, right? Ultimately, the economic dynamic effects of these policies, which are what you need to sell them, right? As more than just, we're giving up revenue. You're giving up revenue, but you're doing it to gain something.
Yeah.
And as I've said, as I've written, I don't know how many times I keep saying it. I'll keep saying it until something changes. But I think this year, the government, since it came to office, has taken decisions to deteriorate the deficit by around $21 billion in a single financial year, which is almost 1% of GDP. And it's not obvious what that has bought us. It certainly hasn't bought us any additional GDP. If anything, it's bought us less GDP, right? It shrunk the economy because the RBA neutralizes that spending, and that generally ends up meaning we get more distortions in the economy, and we lose some of our output, right? So, if you had taken $21 billion in a single year, and you had said, let's just give up that revenue of 21 billion, I think you could get a meaningful improvement in our per capita GDP growth rate, right? With $21 billion a year. I think stage 3 cost 21 billion or 20 billion thereabouts, right? So we're happy to spend $20 billion, and that doesn't need justification. But if we want to cut revenue by $20 billion, we could never do that. We can't give up the revenue, right? And that's a bias, right?
It is. It is interesting that Australia has lower tax to GDP than New Zealand, given how we both just described how decisions are made in the countries. Like in New Zealand, they're much more, the behavior of departments and ministers is much more willing to sacrifice revenue. And yet, I suppose that could be the centralization of the system, though. The New Zealand doesn't have states.
Right.
I think even including state revenue, New Zealand tax to GDP is still higher. And
interesting.
I think, and the marginal rates tend to be a bit lower. It's just the broadness of the GST. It is a 15% GST. It applies to everything except some forms of financing and the resale of housing.
Yes.
Because those are just forms of financial transactions that really don't belong there. Like it is as broad as you get. So I suppose that just gives New Zealand greater tax capacity, although from a much poorer base than Australia.
There's a funny thing. I mean, I just have to note here. I don't know if did you ever watch the documentary I don't know, maybe, probably almost certainly didn't, but there's a documentary called The Howard Years that describes, what happened with the Howard government in Australia. If you want to know about Australian political history, you just watch Labor in Power, which was a great documentary series about the Hawke-Keating government. Howard Years. There's one about Rudd and Gillard called what's it called? It has something about like stabbing in the back or I think that's got Schubert is the song, the music that plays in the front. And then there was obviously one recently for the I think it was Nemesis for the other government. The Howard Years documentary talks about the introduction of the GST in 2000 and what was happening and what they were thinking about. And originally, Howard wanted to do or Costello wanted to do a clean GST like that, right? And the Democrats, which was a sort of crossbench party that used to be kind of like the Lib Dems in the UK, I guess, sort of a sort of splintering of the Liberal Party, a bit more moderate, right? And they demanded that Howard take food out of the GST. And there's this wonderful interview with Peter Reith, who was the industrial relations minister at the time, and he said, the prime minister is sort of like, or the treasury is sort of, distraught at having to remove food from the GST. And Peter Reith says, like, do you want the best GST in the world, or are you going to, cut yourself up about having the second best GST in the world behind New Zealand because you couldn't tax poor people's food? he's like, like, get your political priorities straight, so this takes us on to a second thing I wanted to sort of talk to you about. And it's something that I teach my students, and it's something that my advisor in my PhD, Joel Sloanrod, taught me and taught us, which is, a tax system involves different tools. A tax system is a system, it's a kit of tools. It's like a toolkit. You go to Bunnings and you buy 500 tools in this toolkit, right? It's not, and not every tool is appropriate for every task. And I think there is a great tendency, and it drives me completely bananas. And places like Grattan, I think, fall foul of this quite annoyingly. And certainly places like Treasury, which is they demand that every tax measure be assessed on all dimensions and nail everything. And the GST is not a tool for fairness. It's just not. It's not meant to be fair. We fully understand that poor people, it's a regressive tax. We totally get it. It's not like a magic thing that we don't know that it's a regressive tax. We know it's a regressive tax, but that's not the point. The point is it's just about the most efficient tax we have, with incredible levels of compliance, much higher compliance than really any other tax that we have. And we don't care that it's unfair. Who cares? If we're worried about fairness, then we can use the income tax or the transfer system to kind of counteract the unfairness of the GST. And so that Peter Reith quote, it really made me think, like, I wish someone had said to them and had said to the Democrats at the time, like, okay, let's not compromise the GST. We're going to tax poor people's food. We are absolutely going to tax poor people's food, but let's just put more money into compensation. Let's increase the dole. Let's offer more generous transfer payments. Let's increase the tax-free threshold. Let's do anything we can to offset that equity concern that the GST is introducing, but let's not fundamentally compromise this tool in what it is trying to do, because you're worried about equity, right? And we get these discussions constantly, right? Different tax tools get assessed for different things when fundamentally that's not what they're about.
I think that's a great point, and I know I keep bringing up New Zealand, but it's all I know.
No, it's good. It's good.
When the most recent tax switch happened there, that is exactly how it was sold. So it was an increase to 15%, and there was also a benefit change.
What was it before? Was it 10?
It was 12.5.
Oh, right. So not a big increase. Yeah.
Yeah, it was 10 in 1986, and then it went up to 12.5, I think 1989, and then it went up to 15 in some year, like 2012 or something, but it's left my head. But when it went to 15, there was also changes to the income tax scales and benefit payment increases. And it was communicated that way, and they used a micro-simulation model to show how it would work out distributionally, to talk about how, they made sure that people that were worst off didn't end up worse off due to it. And it went round and out as like a popular tool, bipartisan. There hasn't been any changes. There was no concerns in the public. I just
There
think,
wasn't. There was no. So the opposition, they didn't attack it.
the opposition
Who
have been
introduced
pushing
it?
for the National Party. So that's the equivalent
Which
of
is
the
like the
coalition
Liberals.
over here.
Yeah.
So the Labour Party in New Zealand, they attacked it at the time, but like they're the ones that introduced GST in the first place.
Labor
And
or the Nationals.
Labour.
Okay.
Yeah, and the difficult thing is like, so they've got a big chunk of their party that wants to take food out of
Yes, I saw
GST.
this.
But
I
the
was
public,
very sad
yeah,
about this.
it's so publicly unpopular because there's a lot of communication about how you use these different tools to do different things.
Ah,
Um,
that's so interesting. I mean, there's obviously a bit. There's two issues here. One is, Australia. It was introduced by the right wing. I wish the GST had been introduced by Labor.
mm,
Because I think it would completely have changed the way this tax is thought of. And I wish superannuation was introduced by the Liberals. Because everything's upside down. You know what I mean? So if you look at Europe, the countries, the VAT or the GST is motivated by, in general, like often left wing, objectives. If you want a huge welfare state, if you want to collect a massive amount of revenue to finance a very large government, which they have in Northern Europe, and I mean all throughout Europe, you need a really efficient broad tax to finance it, right? Otherwise, you'll crush your economy, right? So, all of these European countries, which have a lot more in common with the Labour Party, are the ones with really at 20% GSTs, often comprehensive. You know, so I in Australia, the fact that the Libs introduced the GST, the Labour Party, they cannot get to grips with the fact that it's a good tax that we actually want to grow, that we want to broaden, and that we want to raise the rate on. They just can't. I'm not sure they will ever come to terms with that it is in their own interests to favor that policy. And so I think we don't do a great job of communicating with the public that, and I don't think it's hard. I mean, there was a discussion on that documentary as well, I'm pretty sure, of controversy about taxing funerals, and it's like people find it outrageous that you tax funerals, and you say, well, we tax the income you use to pay for the funeral. So what's the difference? Like, it's not like, and then I think if you just explain to somebody that this is kind of how it works, surely they would get the basic logic of that, right? You just have to explain it to people. So I think we really fall down on that basis. So we end up creating massive complexity, and I mean complexity in a bad way, in a way that generates all sorts of distortions and kind of opaque and again the horizontal equity concerns, and it's just a mess. And I think kind of the superannuation tax system is a good example of this. Like it's an insane mess, because we've tried to eat away at it and make it fairer over time. And this is, we compromise taxes all the time because we're worried about this. And I just wish we had a more sophisticated, comprehensive a comprehensive kind of understanding, conceptualization, and communication of a tax system, rather than a GST or a capital gains tax or whatever. And I think getting people over the line on that, I think we need to do that before I think of a lot of the big reforms that I could think of. I think we need to get that bit. I think we need to overcome that, because those reforms are going to require, in some cases, things that people are going to think are very unfair, right?
Yeah.
So
it does sound like there needs to be sort of more public cut through in terms of here is a tax framework and how to use it. It seems difficult to do in Australia though. I can take Bob Bruning for example. He has great frameworks. He communicates them well. Um, it is often out in public describing things, and then you yourself are as well, and uh, Christian Sobek is also now adding things in public, talking about corporate tax, and everything the three of you say is really principled, and yet we still get these weird tax articles that get so much influence in the paper all the time. How do you
Yes.
think, as public communicators, we could, help to turn the dial on the way people talk about tax and think about tax frameworks?
Yeah, it's really hard. I mean, I'm just going to keep banging the drum. I don't know. I'm just going to banging the drum until we actually, break through. I think it could use, I think we need more voices. Um, I think there are not enough, there's not a chorus, and we need a chorus, right? I think
Mm.
that's a big thing. I mean, there's so many Australian academics are so, I don't know why, but like none of them want to talk to the media. My friends in the media are always complaining to me that they can't find academics to talk to. I'm always complaining that academics aren't in the newspaper. And
Mm.
then I talk to the journalists and they say, well, who am I supposed to talk to?
Mm.
And I give them names of people and they don't want to talk to them, So I think, as academics, I mean, you're in a think tank, but it's still the same kind of thing. We have a duty to educate the public, and I think we need to do better. I mean, I do obviously more than my fair share, but like,
Mm.
I think if there were more people clamoring for this stuff, I think it would be helpful. I'll give you one example. So it's not like a new idea, but before the last election, I wrote an article calling for the indexation of the income tax thresholds.
Mm.
And that's a debate. I'm not. I mean, I'm now resolved in my mind that I'm right on this, but it's a debate you could have. But just in the last month, we saw Ken Henry come out and say he's come around to it and he thinks we should index the thresholds. And then your boss, Michael
Mm.
Brennan, who used to run the Productivity Commission, came out and said we should index the thresholds. I wrote an article saying we should index the threshold, and I think the day after, the Teals released a letter saying we should index the threshold. So that's a
Mm.
great example of a chorus forming where you have sort of safety in numbers, so you're not like a lunatic out there on your own, fringe person, but you also just get it gets a critical mass, and it influences other influential individuals, right? Maybe you're more likely to influence the head of a government department, or the people who work in these government departments, right? If you're getting this broad wave of kind of consensus around an idea. So I think that's a key part of it. I mean, I've been banging the drum on, and I'm not alone. I know you've written on this, but I've been banging the drum on negative gearing being good. I can't tell you how many times I've written this.
Mm.
But there's no one, I'm like, I don't read this in the newspaper. I just read, oh, negative gearing is a tax rot that we want to get rid of. And so you just can't get critical mass to kind of
Yeah.
move the dial on sort of the consensus.
That's a
Um,
good example because Chris Richardson has written multiple times saying that as well, like agreeing with you on the,
yes,
negative gearing makes sense. And he's someone who is incredibly influential in
yes,
Australia, and even then it doesn't seem to shift the dial. One thing that did happen in New Zealand is in the 80s there were ministers who were incredibly passionate about tax frameworks.
yes, yes. This is a
And
big thing.
yeah, and there's
Yes,
public servants in senior positions who are extremely passionate about tax frameworks and making sure, look, ministers they have the ultimate say, they have the democratic mandate, but there's a process that needs to be followed and needs to fit within this framework, and advice will be publicly made available that is put in that framework at all times. Um, and does the same culture of principles about tax not hold for politicians and senior public servants here as much. I don't really have much experience with Australia, so.
So I think, look, I can talk about Treasury because I used to work there, and I sort of worked there even when I was in my PhD. I was sort of on and off there, so I had a long run exposure. I think that the tax policy thinking in Treasury has degraded over time. I think there's no doubt about that, and I don't think anyone who is truthful who works in the department could disagree with that statement. It's not that there aren't outstanding people who work in Treasury on tax. I mean, I know multiple people. Shane Johnson. I don't know if you know Shane Johnson. He's recently he's done his PhD on tax policy. I don't want to mention too many names of kind of public servants who are meant to be anonymous, but I can think of 5 people off the top of my head easily who are brilliant tax people working around the department, but they aren't doing that. They're not. There is no skunk works of Treasury working on tax policy. There is no. I had a friend who wanted to get a promotion, wanted to move areas in the department, and went to look for the area that does tax reform, only to find that area doesn't exist. Which, if you think about it in the Australian context, if there isn't an area in Treasury that does tax reform, then there's no area in the country that does tax reform. So what hope do we have to prosecute any kind of agenda? And importantly, if we get lucky enough that the right treasurer comes along, like say Peter Costello in 2000 or in 1998, this was, who, irrespective of party, it could be Paul Keating, right? Whatever. The right treasurer comes along who actually goes to Treasury and says, I want to fix this, or tell me what I need to fix. I do not think the Treasury is in a position today to answer that call. There is no way they are. Now, they might be able to pull something together over time, but they're not in a position to do it today. They had a division called Tax Systems Division after the Henry Review, which was kind of tasked with this, but it was disbanded. And a lot of Treasury's tax policy work has been concentrated in, as you said, international tax boondoggles, I would call them. I think a huge mistake, frankly. And ex post, it turns out to be an even bigger mistake, given the whole thing has been, thrown in the trash. But, I think that lack of intellectual kind of, what's the word? I think it's about developing a stock of knowledge and maintaining it and cultivating it, right? And nourishing it, right? Going to the National Tax Association conference in the US every year, going to the International Institute of Public Finance conference every year, having the world's top tax people visit the department and give a seminar, and constantly nourish and build this brains trust at Treasury, such that they know everything there is to know about tax policy, the frontier knowledge, so that if we wanted to make a change, we would know what to do. Now, that is not there. And that takes a long time to develop. And I'm not sure, maybe they don't have the resources, maybe they don't have the right management, maybe they don't have the right minister. I don't know what the answer is, but I certainly don't think today's Treasury does that. And so that means, man, seriously, no one in Australia does that. I mean, that's really bad. So, I think we'd have to cultivate that if we wanted to have positive change.
The way I often see these types of public service departments is there's 3 attributes to a public servant, and you sort of specialize between them. There's the operational part, where you're thinking, how do you deliver programs? How do these function? How, like, the legalese around it. You've got the specialist part, where you're focusing on the strategy of a specific singular policy and working on that and trying to understand that and trying to understand, what exactly are the trade-offs and trying to pull in measures specific to that policy. Then you've got the framework thinking. It sits between them where it pulls together the way systems interact and then says we have a framework for how we can coherently think about tax strategy as a whole and how things fit together. And we're going to update this with new evidence. We're going to bring all these sorts of things. And then academics and to some degree think tanks come in and there's a framework there and you sort of add to it by adding up-to-date evidence. You support. And so when they're going to these conferences, it's in that way. Now, the first two can be quite reactive. The last one has to be proactive and has to be invested in. And I wonder if, facing fiscal stress, facing, different demands from different types of ministers, it can be very easy to just fall on the first two and not do the latter, even when people are very well-meaning and passionate about the topic.
Yes.
Yeah.
So I think that so this is a broader issue. I wrote about this in the Fin last week. I've been railing against government expenditure for a long time, like 3 years now. And I wrote an article in December where I talked about the public sector strangling the private sector to death. I had a lot of fun writing the article. It made people very angry. I'm not sure I have received quite so much angry replies to a piece as that one. But that piece was about the non-market sector. It wasn't really about the public sector. I mean, it was about the public sector broadly defined. It was not about public servants. It was about, we've got this insane, system that we're subsidizing, all sorts of private activity, and that's kind of spiraling out of control. But the private sector, if we look at the Australian Public Service, it's quite modest. And if you go back to 2005, which is as far back as the data go, today the public sector is public servants are a significantly smaller share of total employment than they were in 2005. So I actually think our public sector is strained, genuinely, even after Labor has tried to do some catch up with these 36,000 hires. They're still way below where John Howard was in 2007. I don't think anyone would think John Howard was a big, pro-public sector prime minister, right? So, I do think the public sector is under strain, and I do think they're under-resourced. I think that's insane because they're so cheap. It's like it's 1% of GDP is public servant salaries. It's like the cheapest thing you could ever think of. And putting some additional resourcing into, say, Treasury to try and build those capacities up would be, if you think about the benefits of spending a tiny amount of money in the scheme of things on building that capacity, if you think of the economic benefits that it could generate in better tax policy, we're talking many, many, many orders of magnitude in terms of difference. So it is the ultimate sort of penny wise, pound foolish kind of thing to go, let's sack the public servants, or let's make sure Treasury can't get enough staff to do the work, right? So I don't know if that's the answer, but it's hard to believe it isn't. The only other thing I would mention is, and I think whichever side wins the election should think about this. And I think the current government has been doing a little bit of this. Big picture thinking is surely the role for the Productivity Commission. I mean, we have this Productivity Commission, which is like when I tell people in America that the government has like a think tank, they're like, what? We have this department whose entire role is to do big picture policy thinking. And I'm not sure they've been marshaled in the right way. I'm not sure they've been developed in the right way to really fulfill that. And I think that could be maybe an option for taking some of the pressure off the departments, where the departments can't quite devote resources or time or whatever to this big picture thinking. Why don't we allocate a productivity commissioner to tax and fiscal policy or something? Like, why is there not a productivity commissioner who literally does tax policy? And that's all they do. They just beaver away writing reports. Maybe some of them never get released, like whatever. But they get commissioned by the government to go and investigate parts of the tax system. They work with Treasury. You could have a productivity commissioner that did monetary policy and did that sort of stuff. You could have a productivity commissioner that does, a specific, like NDIS specifically, right? I think we could probably leverage the PC better, and that could help to kind of be part of this chorus that we're talking about to kind of push the reform process forward.
I like the idea of the Productivity Commission doing more framework thinking. I do have a hot take that I'm pretty keen to drop though. So
Hot take.
yeah,
Here we go.
I agree with you that the public service in Australia and New Zealand is way too small. The New Zealand tax department as a percent of the population is like the smallest in the OECD, even with all the stuff they're trying to achieve. And there's similar sort of things going on over here. And over time, it has become compressed. And during that same time, we have seen politicians increase the size of their ministerial offices. We've seen them increasingly put pressure on public servants to come out and say things they want and to bash public servants in public because public servants can't say anything. I think an independent and well-resourced public service that can provide information to the public is necessary to make sure that the public meets their democratic mandate, because politicians are often trying to mislead messages. And I think that neither side of the political spectrum wants that. They want to get in and they want to take advantage of it. And I think, I can't look at any politician as being principled unless they're going to turn around and say that they want to improve this.
Yeah, I mean, I'll give you another recent example. I mean, and recently I wrote that we need independent budget forecasting, which is like so trivially, obviously true. I think it's like, should the treasurer be able to just say, "Hey, actually, I think that GDP growth forecast needs another quarter point on it," like which to be honest, right? If Jim Chalmers, ahead of the budget on Tuesday, wants to call the treasury and say, add a quarter point, like they'll do it. Like it's the budget has the treasurer's name on it, right? It's not Treasury's document. And I know that it's compromised. All of that stuff that the public perceives as being independent is totally compromised. But I put a proposal out to make it independent, and there's all sorts of options for that, for how you would do it. But what is the chance that either the treasurer or the shadow treasurer will commit to that policy? Zero.
Yeah.
Because who wants to give that up, right? So no, and I don't know the answer to this, right? It's a bit hard. I'm not sure what the solution is. I mean, we've had the RBA reforms that we've had recently, I think are pretty good. Not perfect, but I think pretty good. And they've certainly improved the RBA. So maybe you just need enough public pressure eventually that shows that the system's not working, that kind of builds the case for some kind of change,
My concern is the US. Like, if we look at the US, since the 70s, they've been doing this to the public service, and it's led to the opposite. Everyone blames some deep state that doesn't really exist. Public servants doing things to them while barely being paid enough. I remember going to the OECD and the US delegate having to fly over business class, pay for all their own food. They had the most important job there, and they were earning hardly anything. And they were doing it out of passion because they cared so much about the United States and about tax policy. That
crazy.
Sort of crap ain't sustainable.
No, it's crazy. I tend to like the Singapore model of like public servants should get paid a fortune. Again, they're such a tiny fraction. Like, again, like you think about it, right? Think about just put it in the scale of a company. What the equivalent executive in a company, and this is someone who's responsible for the whole national policy on something, and we can't do it. So I would like to move in the direction of much more. The last thing I would be doing is defunding the public servants. I would be going way in the other direction. It's worth mentioning one more thing, which is if we're just talking about principles, and I guess we're an hour in and we haven't talked about tax policy yet, so we could do that. But one more thing that's worth mentioning as a sort of idea, we talked about, this idea that we need to think about the triangles and not just the treasury, and we need to think about, a tax system as a toolkit where each thing does a different thing. The other one that I think is really important, and this comes from, I'm heavily influenced by my sort of PhD thesis advisor and mentor Joel Slemrod in that we need to, and this is like my mantra and what I teach my students, and how I think about tax policy generally. We need to think about the damage taxes do as just far more broad than labor supply. I mean, that is like still when I read in the newspaper, why a tax is bad because it deters work. And it's like, this is like 70s thinking. We're like 50 years behind, right? Taxes are bad because they distort behavior along infinite margins. Infinite margins. And ultimately, anyone who does public finance understands, the any behavioral distortion that shrinks the tax base is equivalent to any other, right? So if I raise the tax rate and you work less, okay, that's bad. If I raise the tax rate and you evade more, that's equally bad, right? Or if you go and pay for a lawyer to give you advice to like reduce your legal tax footprint, that's bad, right? That's shrinkage of the tax base. So there is a sort of, we should be thinking about taxes in a much more, just in a much broader way in terms of their negative consequences. We should be thinking a lot more about, administrative and compliance costs, enforcement costs, long run impacts. How do taxes affect culture? How do taxes affect the way people feel? Like, I mean, the sort of the complexity of the effects of these things are quite enormous. And a part of this is, sorts of different things we can measure. Maybe we can't measure them all, but part of it is also a narrative thing, right? Trying to make the case for why a tax is good or bad has to go well beyond, traditional measures. And one example, I mean, the simplest example I can think of is if I ran a poll among even economists and I said, why is the GST good? I think most people, almost all of them, would say because income taxes distort work incentives. And moving from income taxes to consumption taxes is therefore good. That's
crazy
completely
if
wrong.
economists said that. It'd be crazy.
I've seen economists say this.
Really?
They've written it in the newspaper.
Oh no!
I've talked to them and they've said this to me. And I think if you ran a poll, that's what you would get. You would get a significant portion of people that said that. And the basic issue is, if I lower your wages or I raise the cost of the things you use those wages to purchase, both deter your work incentives. There's no kind of magic, right? The GST has got nothing to do with work incentives. It's to do with savings, and it's to do with compliance costs. Enforcement. The degree of tax evasion. That's it. There's no like income equals consumption plus savings. This is not complicated. So, I think that, thinking there is just this bizarre one-track mind. And I try and press these other issues when I talk about the damages taxes do. Because I think, if we want to sell the case for reform, we have to be super clear about what the damage is, right? And we certainly don't want to understate the damage, right? I mean, this goes back to the citation is probably Feldstein, 1999, his paper that sort of laid out the elasticity of taxable income. It made this point, right? Which is, the damage of income taxes goes well beyond the labor supply distortions. It's all about, all sorts of other distortions along lots of margins. So I would just, lastly, I would just push that point about thinking about the damage in a much more broad framework, certainly in the way we're communicating it to the public.
Yeah. And I think I think it's easy to get the damage point out when people are able to talk about income in the right sort of way. So I see you dropped a semi-reference to Hague-Simon income there, and that really being the base for how we'll often
Yes.
talk about
Yes.
our income tax system. And so in that situation, you're taxing real consumption opportunities. So you're thinking about taxing accrued capital gains, but
Yes.
not the nominal component of interest income or capital gains and such. And so that was a powerful framework through the 70s and 80s for defining tax return,
Yes.
tax reform, to use the actual words. But I'm pretty interested in the fact that capital gains treatment is so different than that ideal, and both Australia and New Zealand. It's not being taxed in New Zealand, and then this 50% discount in Australia. A colleague of mine, Matt Maltman, messaged me late last night to say that he's found a Treasury document saying 96% of realized capital gains are taxed at the discount in Australia in a given year. So the rate is really half normal rates. How would you go
Yes.
to think about the taxation of capital gains and sort of the right way to do it?
Okay. Where do I begin?
Yeah.
So you got to talk about this in two stages. One is, well, okay, there's three stages. One is, are we taxing income or are we taxing consumption?
Mm.
And I think that is a choice. We could not tax capital gains. We could not tax labor income. We could just tax consumption because, as I just said, income plus saving, income equals consumption plus saving. There's
Yeah.
nothing else left, right? Now, in reality, we do a mix of these things. We tax income and consumption, right? And so we kind of do both. But if we presuppose that we get to tax income, then the second question is: do we tax labor income? Yes. Do we tax capital income? And I think and capital income includes capital gains, but it includes cash flow, like flow income. So I think that's an open question, and I don't think
Mm.
there is any form of consensus on this question, and I don't even know if I have a view. I have a view that I tend to like low rates of capital tax, but I don't know how low. And I think it's tricky, and it has a lot to do with if you push the capital tax rate too low, you get a lot of reallocating labor income as capital income, basically.
Yeah.
And so then that's a bit of a can of worms, and I'm not sure where to end up on it. I think what we can agree on is there is some concession below labor income. I think in an ideal world, I would have a zero rate of capital income tax, but these practical considerations means you have to tax it at a non-trivial rate. I would say 15 to 20% flat rate, maybe something like that. I think is a fine level, which is significantly below even the CGT discount level, right? So certainly below the level of interest. Interest income is taxed at 47 cents, which is
Yeah.
completely bonkers, right? I mean, that's like absolutely bananas that we do that. And yet super is taxed at 15%. The family home is taxed at zero. It's like, what on earth is going on?
Mm.
And then the third question then is, okay, how do you tax the different forms of capital income? Are they taxed equivalently, differently? And then CGT is sort of one part of that. And capital gains are particularly important because they are so weird. They are just weird. Like they're different to everything else. There's,
Yeah.
dividends and interest are kind of the same. Rent, yeah, it's the same. There's all sorts of cash flow that's kind of like what we think of as capital income. Capital gains are just different because you've got to trigger a realization event in order to pay tax, right? So that's, I guess, my logical flow of how I think about capital tax. My view is that we should move to a system like the dual income tax system that basically puts a uniform flat rate of tax on all forms of capital income. And you basically, when you run your tax return, like I don't know if you've ever looked at a paper Australian paper tax return. I mean, you go to e-tax or whatever and it's there, but if you actually print out the form, there's like a section called like business tax on the individual form. Well, you would have a section below the personal tax section that would be called capital income. And that section would include all forms of capital income and all capital expenses. That would include trust income, anything that isn't labor income, basically, and it would be netted off within that category. Everything inside that would be netted off to create a net income measure for capital. That would then generate a tax liability for that section at that flat rate, with an amount of tax owed less some withholding if there was withholding on some of it, and then that liability could be used could offset some could be offset against any personal income tax credit that was available. And that dual income tax system would basically neutralize all the rates across forms, which I think would have a lot of beneficial effects. As I said, like, we shouldn't be taxing interest at 47 cents. That's completely insane. I mean, and we shouldn't, ideally we would have this be comprehensive. And the other advantage it would have is by hiving off all the capital items into their own little bucket, you would basically, there is a distortion associated with negative gearing, which is that the rental expenses are deducted at 47 cents, but the rental income in the form of capital gain is taxed at 23.5 cents. I don't have a problem with discounting capital tax, but if you're going to discount the income, you've got to discount the expenses as well.
Yeah.
And we don't do that, and that's completely nuts, right? So, if you have the whole capital return in a bucket here by itself, you would neutralize all of those effects. So, your deductions would be 20 cents, your income would be 20 cents, everything would be 20 cents is what I would do. At the same time, I would raise the tax on super to 20 cents to match, eliminate its advantage. No reason why it should be taxed at a lower rate. And then your question is now, what do you do with capital gains? I think there is the pure answer is that all forms of capital income should be real, not nominal, right? Whether it's capital gains, or whether it's interest payments, everything should be nominal returns, real returns, sorry, not nominal returns. That's pretty easy to implement. I don't have a problem with doing that. I think the remaining problem is that you still have the capital gains tax getting the benefit of deferral, which is you only pay tax on the capital gain upon realization, which means if I don't pay out a dividend and I retain the earnings, the money that I would have paid in tax to the ATO, I'm earning a return on it, and that's an advantage. It's a distortion, which pushes us to the world of wanting to tax on accrual, not on realization. But the trouble with taxing on accrual is obvious, which is it's completely, it's politically insane, but more importantly, it's practically very difficult because you have problems with valuing unrealized capital gains is easy for stocks. It's harder for rent, it's harder for property, and it's way harder for other forms of assets like closely held businesses or farms, or asset, a painting or a fancy car, or who knows. And then the other issue is obviously tax is a big problem with taxing unrealized gains is the liquidity issue, which is you're taxing people on money they don't have, and so they have to take out a loan, or they have to try and liquidate some of the asset in order to pay the tax liability, which, we do that with property taxes here in the US, but it can be a problem. And that problem can lead to political pressure that fatally compromises the tax base because it's too much of a hassle. And so I think basically what that leads me to say is we just give up and just say we just tax capital gains on realization. We account for the inflation. We do the same for all forms of income, not just the capital gain, but also the flow. And accept that there's a bit of a distortion towards retaining, and that's life. I don't know. What do you think? Is that similar to what your view is?
No, I think that all makes a lot of sense. There's the our back proposal from 1991, I think, to sort of inflate gains by their present value to get rid of that differential treatment. So that's a very nice way of thinking about it. There was something
I think it's imperfect. I think it's imperfect, if I remember correctly. Like you can never quite you close some of the gap, but you can never quite get there. But yes, it basically taxes you as if you had tax on accrual, but you don't have to pay the money until you realize, right? So
yeah.
But were you going to mention the Ben Mole thing?
Future Matt here. So I butchered people's names when I was recording this part, so I thought I'd just add them in. The authors of the paper are Mark At.we, Benjamin Mole, and Florian Schuyer. I'm sure I might have still got them a little bit wrong, but hopefully that's better. Now let's get back to the podcast. So they were essentially saying, hey, when we talk about tax, we're really going back to Kaldor and talking about the idea of a just straight expenditure tax. And taxing capital gains might feel sort of weird there. We should be thinking about, what can you eat? What's the final consumption opportunity? When you've got a capital gain, it can be because there are changes in dividend payments, or there are changes in the risk-free rate. And if there's a change in the risk-free rate, that capital
you
gain,
don't want to tax that.
that's not really income. And man, people forget that. Even people that are very expert at tax forget that point all the time. So I was just happy to see them push that out.
No, absolutely. So I think, and then the other question is corporate income. Which we forget is just capital income at the entity level. It's just like the rest, which when you think about it like that, highlights the insanity of not having a pass-through system, And I am increasingly of the view on the corporate income tax that we basically shouldn't have one. I think, and for domestic investors, we don't have one. Right? We just don't. If you've got a company that is 100% domestic investors, there is no corporate income tax. There just isn't. It doesn't exist. It's just a withholding system that gets refunded. And we have a corporate income tax system that is masquerading as a corporate income tax system, but is really a foreign withholding tax. For people who don't live here and aren't Australians for tax purposes, we want to make sure we tax their income. And so we do it through the corporate income tax. Now, I'm not sure. I think that's kind of weird. We could just get rid of the whole corporate tax system and just have a withholding tax on foreign investors. We could do that. It would be much simpler, right? You could radically reduce the compliance burden and the complexity of the whole system. Franking credits would go away, but the corporate tax would go away. I think we could do that. I think the only one we ought to think about is whether we want a corporate tax system for a kind of as a kind of rent tax, which you might think that you can only tax rents at the entity level, which is why you want a corporate tax. And if you're going to have a corporate tax that's a rent tax, I actually think you want to get rid of the franking credit system, and you just want to have like a tax on supernormal profits, right? Which we can implement in a few different ways.
Like an ACE.
An ACE or like the destination-based cash flow tax kind of thing, or whatever, right? And we tried to do this with the mining industry in 2010. That was the sort of mining tax proposal, was a sort of a rent tax on mining companies. There's all sorts of design details that you have to nail down, and anyone who thinks you can tax rents without distorting any behavior is kind of naive. You're always going to have some distortion, but I think if we were to do that, I think we would basically want to get rid of imputation, because you want to tax rents. You want to tax rents. It doesn't matter whether the domestic investor or the foreign investor is the one receiving them. So
Yeah.
whereas if we think of it as a tax on capital income, then I think, yeah, you want the franking credits, and you basically want to move to a withholding system on foreign capital owners. So yeah, and we're way away from that. We're far away from that system now. So, but I think that's the sort of thing that Treasury would basically, you'd have to pry it from their cold dead hands in order to get major corporate tax reform that involved kind of that level of giveaway.
I think both those things make sense. The two there are two things that come to mind though. On the destination-based cash flow tax, I think a world where
Oh, I
all
read your
countries
thing on this, by the way.
yeah.
I saw you had a post on this, I think. Did I see something
It
recently?
was I think it was an E61 newsletter article. So
Okay.
sometimes
I
I do
read
things
something
for
by
my
you.
work and
Yeah.
sometimes I do it for myself.
Yeah.
I think Australia is unique in terms of if everyone switched to that, uh, would lose about $62 billion in tax revenue because it switches the location of where the rents are taxed. So it does tax
Yeah.
those
I
rents,
mean,
but
you'd lose mining
yeah,
profits. You wouldn't be taxing
yeah,
any mining profits.
yeah,
And finance sector. The finance sector and mining
yeah,
would be the two big ones, right? So I think
yeah.
if you actually don't want a destination basis, you want an origin basis when the
Yeah.
origin is like valuable to you.
Exactly, exactly.
So
Just
you
for
would
us.
want a mining tax and maybe a financial services tax of some type, I guess.
I think the other thing that comes up is I've got increasing sympathy for the imputation system after seeing this digitalization and BEPS process by the OECD. So,
Right.
the corporate minimum tax rate that they're introducing for multinational enterprises of 15%, sort of based
Yes.
on the guilty approach. Um,
Yes.
so for countries like Australia, they're counting the corporate tax payment as corporate tax. And countries where the corporate tax rate is set to zero, like Estonia, um, and Saudi Arabia, they're like, well, Saudi Arabia doesn't even have a corporate income tax system. They're like, you have to introduce one, or we're just taking this revenue from you further up the chain of countries that are trading through that process.
What do you
Um,
think about this? I think this is nuts. Do you think this is nuts?
I think it's
Like, I
pretty
think it's
uncomfortable.
bad.
I mean, countries like Estonia and Saudi Arabia are pretty uncomfortable with that because, they've designed a tax system based on the what they see as a
Yeah.
efficient and equitable way of sharing the
Yes.
tax burden. Seeing,
Absolutely.
Corporates as
And
look-through
maybe,
entities.
by the way, their tax system is different because of that.
Yeah,
Like they have other taxes that they are implementing because they didn't do that one, right? You can't
exactly.
really, yeah.
Yes. So it does feel like it's trying to force them into a corporate system. I know Ireland also has substantive concerns. But those come from a bit of a different place, I suspect.
I also
Um,
think I hate minimum taxes because
yeah.
it's very simple. If you deny deductions to businesses, you're going to have a type 1, type 2 error problem, like you're going to deny legitimate deductions whether you like it or not. You just there's no magical
Yeah.
way that you aren't going to do that. And if you do that, you're making the corporate tax more distortive. You're moving
And
towards a gross receipts tax, right?
if you're trying to avoid that, so I believe there's a whole series of complicated rules about which countries need to like if firms overpay tax, what countries will need to relieve the burden in future
Yes.
years, and of course the jurisdictions are arguing with each other about that. Hugely compliance heavy. And that's why the
Yes.
Pillar One reforms can't get through. People are just like, I mean, you've got Australia concerned about the way that wholesaling activity and like the transportation of mining is going to be treated by the system, even though mining itself has been taken out. A lot of the
Yes.
transport's still in there. You know, and then you've got a whole series of other countries just worried about how it affects their tax capacity. So I mean, that's why Pillar One hasn't really gone
Right.
forward, and with Trump
Right.
now, yeah.
Yeah. It's dead. So,
Yeah.
I think so. I the only other thing I can think of. So we've talked about GST. I think GST If it were me, I'd set it at 20% comprehensive. And I would radically reduce income taxes. I would get the states to get rid of all their stupid taxes. You know, stamp duty on insurance, like it's completely nuts that we tax insurance.
Mm.
And I would radically reduce income taxes, and I think that would be a much better system. And increase transfers, actually. So I would have more generous transfers. I would have lower income taxes, and I would have a higher and broader GST. And I think we'd have an economy that grew much quicker if we did that. But, we'll see. We've talked about corporate and capital income tax reform, which I think is a priority, ought to be a priority. If I was the treasurer, like that would be my number one priority, probably. Is fixing that system, that capital income tax system. And then the other one that I think is important is, I think our transfer system is nuts. I think the combination of if you take all of the subsidies, we created this insane effective marginal tax rates, right? Because we have all these, we have, I think, the most aggressively means tested transfer system in the world. I'm pretty sure people say this.
But probably second.
Second in New Zealand.
Yeah.
Very good. But that's problematic for many reasons. One, obviously, you get these crazy incentives, which we've done not enough work to understand. Let me be clear. I'm working on a project with Ellen Stewart at University of Sydney and Ash Craig at ANU on the family tax benefit system. So we're trying to figure out what these effective marginal tax rates are doing. And we have some pretty nice data, and we're kind of digging into. We have some pretty nice variation, and so we're trying to figure this out. So watch this space. But I think there is a bizarre. I don't know if you've picked up on this, and I don't know if it's the same in New Zealand, but there is a tendency for people to ignore the incentive effects of benefit withdrawal. And to think of means testing as this fantastic thing, this sort of thing that gives you a free lunch. Whereas, if you think about it, if I give you a transfer when you're poor, and then I withdraw the transfer as you have a higher income, it has a theoretically identical effect on your incentives as if I tax you more.
Yeah.
Right. And so we could have a targeted system of transfers where we withdraw the transfers, or we could have universal payments that we finance through more progressive income taxes. And both of those things are equivalent. You can actually write them down so that they're identical. Right?
Yeah.
But people, in the way they discuss these policies, I know people in Treasury, people more broadly, they somehow think that the targeting transfers thing is some kind of free lunch. And I think it's a free lunch if you assume effective marginal tax rates don't affect behavior. But I think there's lots of evidence to say they do. So, and I think the other big problem with this incredibly targeted, transfer payment system is that it's extremely horizontally inequitable. It leads to bizarre interactions and overlaps, and it's very opaque. So I don't think people really understand it. I think there's all sorts of problems with this sort of system. So I don't think what I would like to see is a kind of a stock take. Again, get the Productivity Commission to do a stock take of all of Australia's family payments, all of its benefits, family payments, transfers, childcare subsidies, throw it all into a table. Show me every single payment to someone on low income, or someone with a disability, or someone with kids, or any of these kinds of transfer payments. And let's set about kind of rationalizing the system. Obviously it would be great to have more evidence on its effects. And again, we're trying to do something about that, and hopefully more people will. But but generally rationalizing the system. And a good example is, the combination of family tax benefit part A, family tax benefit part B. Those two payments have supplement payments. The single parenting payment, the the childcare subsidies, the subsidy for what's it called, when you have a baby,
So it's paid parental leave now. There did used to be a baby bonus.
but paid parental leave,
Yeah.
also just a transfer to family. Like if you pool together all of these transfer payments that have something to do with having kids, it's like $50 billion a year or something insane. I mean, I don't know, but it is a truly colossal amount of money, and it's delivered in just a sort of an incredibly haphazard fashion. And I'm not sure that anyone could go, what is the objective of this policy, and what is the sensible way to implement it? We wouldn't end up with the system we have, right?
Yeah.
So, I would love to move to a system that was basically a single payment for anyone with kids under 3. You have a kid under 3. If you have a kid over 3, you should be able to take them to any public school in Australia. If you have a kid under 3, you should get a completely flat transfer from the government per year for the first 3 years. And if you want to use that money to support one of the parents to stay home with the kid, then you can do that. If you want to use it to pay for childcare fees, do that. If you want to use it to buy a nanny, you can do that. I don't care. We're just going to, as a country, recognize that the first 3 years of a kid's life requires income, because there's a big income hole, and we think it's a good idea to subsidize having kids as a society. Let's just pay people in that simple fashion. I think you could generate a pretty generous payment with all of the funding that we currently give to, again, childcare fees, FDB, all of these different things.
That's a good point. So the transfer stuff is an area where, where I am's been doing quite a bit of work. So next week, and actually once it'll be out once this is released, colleagues of mine, Sylvia Griselda, Aaron Clark, and Rose Qatar, will be releasing a piece on childcare subsidy reforms and their labor supply effects, and also just generally their cost and how they were distributed. And I believe they've got a whole lot of effective marginal tax rate stuff in there, and how to think about effective marginal tax rates with FTB, A, B, and childcare. So that'll be out by the time this is released.
Nice.
Also, there's a whole huge number of us. So I've been doing work on the job seeker payment and job loss risk, sort of thinking about what are some reforms. You talked about a minimum sort of universal basic income with clawback in the tax system, also an unemployment insurance scheme. How can we think about the current system and those alternatives? So we're writing up a sort of policy, quite large policy document on that for much later this year.
Okay.
That's just it's gonna take a bunch of the research we've done and that other people have done. So on that would also
there's what's the guy, Jonathan Heathcote at Minnesota Fed. He has a paper on optimal unemployment insurance. That I read recently. And it deals with the sort of moral hazard issue, right? The fact that, if you design a UI system where you assume perfect compliance, you're going to maybe get a 80 or 90% replacement rate optimally. But if you account for the fact that there's, illegitimate kind of usage, people are going to quit their jobs basically to get access to the unemployment insurance system, or even collude with their employer to do that. You should have a much lower replacement rate, in the order of like 50%. And I thought that was pretty interesting, because I've advocated for a sort of unemployment insurance system with a much higher rate that steps down. Now we're way away from 50% even with the job seeker rate for most people.
Well, it's interesting for a full-time minimum wage worker. If you're excluding super, so you're thinking it's solely about liquidity,
Yes.
The replacement rate's about 53%, highest level since 2006.
Yes, but minimum wage worker.
Yeah. So for it depends on your objective, right? But across the system, there's pretty huge heterogeneity in replacement rates. A lot of which is driven by what you're discussing with different supplements and different types of payments.
Yes.
Um,
Yes. I think there's a lot to do in that space. I think it's important. So yeah, I don't know. Is there anything else you want to talk about? I think I've got, most of the things out of my head that I've been swirling around in there.
Yeah, no, I think that was great. I'm glad we took it to transfers at the end as well, because it's a pretty, easily understated issue. I think just like reinforcing to everyone that, transfers matter and we're thinking about a tax transfer system we want to be coherent
Yes.
across is
A
just super
transfer is just a
important.
negative tax,
Yeah.
right? So it's sort of, we shouldn't be thinking about them separately.
Yeah.
And there's all sorts of strange things, right? I mean, yeah, it's incoherent. Which I mean, I think it's use as what we said before. Use the tool, design the tool for what it's going to be used for,
Yeah.
and don't fatally compromise the tool in an aid to achieve everything. Um, and I think our family payment system is a great example. Our family payment system should be about helping people with kids. Like that's it. That's what it's about. When you have children, they're young for a little while, and your life is impossible, and there's a sort of lifetime risk element there, right? And you're sort of you're helping people at a time that is challenging, and we think that's socially desirable, and we should do that. So that's a world where I think there should be not a lot of focus on inequality in
Yeah.
income, vertical inequity, right? We should be focused on you're a parent, you need some assistance, we're going to give you the assistance, right?
Yeah. No, it's a fascinating debate, but seeing that we're about to hit 2 hours, I should probably let you go. So thanks
Yeah,
for the
good.
chat, Stephen. It was great fun.
Yeah, cheers, mate. I'm going to go put my kids to bed.
Excellent.
I'm just out of this first 3 year range to being in the range of, I'm
Yeah.
finally living my life again.
Yeah,
It's been a great chat, mate. We should do it again. Thanks for taking the time.
definitely.